It's time for Declare Your Independence with Ernest Hancock.
Propaganda, propaganda, you can liberate the babies from their candy. It's so easy, it's a sin, you're gonna wanna jump right in. You can always depend on propaganda.
Oh, there's a lot of propaganda out there. You know, we're trying to, cut through the crap here on Declare Your Independence with me, Ernest Hancock, my very, very, very special guest, Robert Prechter from ElliottWave.com. 2 L's, 2 T's. Now, I want to go ahead and get right to, we only have you for a limited time, one more segment here, so I want to make sure that we get right to it. Now, we have Elliott that, back in whenever, says, look, man, I see the cycle on this, and it goes to about 2012. Okay. So,
yeah, pretty cool call.
Well, what are we looking at? What was he predicting? And you've been advocating, there's going to be a big, giant reduction in prices. We're going to have a deflation. Define that, help us out.
All right, let's start with the R.N. Elliott thing. He wrote this piece on August 25th, 1941. Now, think about that. We had just gotten involved in World War II. People were scared to death. The Axis powers were in the ascendant at the time. We had just come out of a Great Depression, and now we were in a global war. All right? Think about that, how people felt. And he came out and said, look, the bear market is basically over. It bottomed in 1932. We're going to make another low here in 1941. It actually occurred in April 42, a few months later. He said, and then we're going to go up and up and up for decades. He drew it out to top approximately 20. He wrote 2012, and I think that's pretty good. We're hanging up here in 2011, still in quintuple digits in the Dow Industrial Average. But he said, look, that is what we call a super cycle. It's a very long, multi-decade advance in stock prices, in optimistic mood, and all those things that create prosperity. But then it's going to turn to the downside. We're going to have another repeat of something like 1929 to 1932. So that's what I've been writing my book about. That's what Conquer the Crash was about, which I wrote in 2002. And I said, you need to prepare. Real estate's going to drop by 90%. Of course, it's down about 40 plus now. I think it's about halfway to the goal.
Whoa. You said 90% reduction in real estate?
I said that in 2002. That was before everything peaked out. Yeah.
Wow.
Well, of course, if you're in Las Vegas, it's already down at 68. It's pushing 70. So, these are highly rare events, but it's something that people are only sensitized to if you study history. And if you study the waves and realize, when are we at these points of extreme optimism when the only direction you can go is down? You remember 1999. Ernie, I'm sure on your show you were talking about the economists who were telling us it was a new economy. Remember that phrase?
Oh, I didn't start radio to 2003, but I know exactly what you're talking about.
Yeah, okay, and the Fed and the Greenspan is like a maestro. They called him the maestro because he was there with his baton, just directing the economy in perfect tune. They call it the Goldilocks economy. There's so many ways they were expressing that optimism. It was ridiculous. And I was writing a book at the time called The Wave Principle of Human Social Behavior, and I said, this is what peak optimism feels like, folks. Now we're going to go into a multi-year period where you're going to have setbacks, you're going to have more conflict. It would probably result in wars before you're over. You're going to have declining stock price, declining real estate prices, and everything else. We're still in that period, and we're just passing the midpoint. So we've had the initial kind of shocks where people were very surprised that, debt started to implode and real estate prices went down. But I think the real thing that people have to prepare for is the deflationary period. There have been subtle deflation going on, especially in the real estate area and in some other areas as well. But the real hit, I think, is coming between 2011 and 2016. And that's where you need to be prepared right now, basically.
For what? I mean, you say, deflation, inflation, define each of those terms and how you think it's going to manifest itself for Joe Public.
Yeah. Inflation and deflation have to do, at least in my view, with the total amount of money and credit in the system. When there's too much credit, as there has been in many bubbles in the past, people default, credit implodes, prices fall back to below normal, and that's the crash period. We've had the greatest buildup in IOU issuance in the history of the world in the last 15 years. It's just been unbelievable. They were, as you know, they were selling houses to people that were literally flat broke and couldn't even make the first payment. So they made 110% loan so they could make a payment or two so they could package it up and sell it to these pension fund managers, right? Mm-hmm. All right. Now, that is an extreme in credit, and that's why the housing market is deflating earliest and fastest, because it was all held up, or mostly held up, by credit, and most of it was bad credit. And now the problem there is that, guess what? Mortgages are the basis of our depository money system. If you go to the bank and everybody walks up at once and says, I want my money, the bank's going to say, I'm sorry, we don't have it, but we do have this nice vault full of mortgages. You want to, you can tear off your portion if you like. So our whole money supply is at extreme risk, and so are the banks. You need to make sure you get liquid to avoid the ultimate results of deflation, which is to lose the value in your stocks, to lose the value in your real estate, and ultimately to lose the value in your bank account.
Okay, so we're looking at the same time we have people screaming that, I guess this have, so we have the common definition. Inflation, increase in the money supply. A lot of people will look at and go,
money plus credit. Money plus credit.
Okay. So you're saying available, I get to go buy.
Yes.
Okay, so as I get to go buy goes away, that's going to have an influence on commodities, prices of stuff, everything. So you're saying that there is going to be a reduction in prices, and mainly, I guess, because people don't have a job.
Yeah, well, and they won't have a job because all the IOUs that are supporting the system are going to start imploding. And that's what happened in 2008. The Fed stepped in and said, oh, my God, we need the government to guarantee all this bad paper. Had they not done that, we probably would have gone into a free fall. Right at that point. But instead, they simply delayed it, and they're, of course, making it much worse because they're guaranteeing really lousy debt that stupid people decided to invest in, and they're the ones that should have paid the price. But no, they made the taxpayer come in and guarantee all of it. So the Fed has created an extra $1.2 trillion worth of new dollars. That's new inflation-created money. But the problem is that there's a whole lot more in terms of IOUs out there. The debt that's ready to implode is bigger than the Fed's money supply. And to me, that is what is going to cause the ultimate contraction, and the ultimate result is going to be deflation.
Well, just in the
fall in general price, which will result in a fall in general prices. But people won't feel rich because they won't have jobs and they won't have any money.
Well, unless they got a bunch of something else. But
right. And if they follow the instructions and conquer the crash, they'll be one of the few people like Bernard Baruch and Joe Kennedy who came through that whole thing unbelievably wealthy, because they didn't get stuck in those things. And I'm telling people how to do that in the book.
Conquer the Crash by Robert Prechter. Now, the thing is that I'm looking at what's happening from Joe Sixpack. He's out there. He's looking at this. He's not quite understanding what's going on, inflation, deflation, back and forth. And just recently, or last few days, this the news of $600 trillion in derivatives sitting out there needing to balance itself out. What impact does that have?
It's huge. The derivatives are part of the problem because every one of them is either an IOU or an IOU if. If X happens, I'm going to owe you money. Well, X is very likely to happen because a lot of these derivatives pay off when disaster strikes. So that's more debt that's going to be piled onto the system from people who can't pay it.
Oh, yep, that's what we got to go look forward to. Elliott, ELLIOTT Wave, WAVE.com, ElliottWave.com. Thanks to Robert Prechter giving us some heads up. You guys need to know this. Yep. We'll be right back here on Declare Your Independence in just a little bit.